Hello everybody, this is Yashwant. I am here to take the technical presentation on about concept of joint stock company. A joint stock company is like a company whose shares can be bought and sold by shareholders. Uh, let's go on to some introduction is about a joint stock company is a business entity in which shares of the company stock can be bought and sold by shareholders. Shareholders have limited liability, meaning they are not personally responsible for the company debts. Joint stock companies are a popular form of business organization due to the ability to raise a large amounts of capital. If this is the concept, we in every company they see the profit. So to increase the large capital, the net worth of a company, they use such type of a concept called the joint stock company, which are uh, useful due to ability to raise a large amount of capital. And history of a joint stock company. The concept of joint stock company dates back to the 17th century with the formation of Dutch East Indian Company. Joint stock companies played a crucial role in the development of global trade and colonization. Today, joint stock companies are prevalent in various industries from technology to finance. There are some types of joint stock company. Joint stock company are three types: the chartered company, registered company, and statutory company. In the registered company, there are two types of companies. There are limited companies and unlimited company. In the limited companies, there are two: limited by promise, limited by share. In the among the limited by share, there are another two is that public limited and private limited. Let's understand some of the legal structure of joint stock companies. Joint stock companies are registered entities with a separate legal identity from their shareholders. Shareholders elect a board of directors to oversee the company's operations and make key decisions. The company's articles of associations outline the rights and responsibilities of shareholders. There are some advantages of joint stock company. Uh, the main advantage is that able to raise a large amount of capital through the sale of shares. Limited liability protects the shareholders from personal finance risk. This is one of the major advantage for the shareholders who can use this concept to invest in shares or sold the shares. By this they can, if the company get into trouble, they can did not go into the personal financial risk. So these are the best advantage for the shareholders. Shareholders have the opportunity to participate in the company's profit through dividends. They are they are not much personally financial risk, but they enjoy the company profit through the dividends. And there are some disadvantages of a joint stock company. uh, we know that shareholders may have a limited control over the company operations because they are not much uh, because the shareholders are already elected some board members to take these key decisions. Regulatory compliance and requirements can be complex and costly, yes, and shareholders are exposed to the risk of market and volatility affecting the value of the shares. And there are some financial analysis of a joint stock companies. Financial analysis is again taken into the two consideration, that is a test of profitability and test of financial health. Test of profitability is like debt ratio and current ratio, correction period. And test of financial health is about return on sale, inventory turnover, and return on investment. Financial involves evaluating a company's financial performance and position, and key financial metrics include revenue, expenses, and profit margins and debt levels. Investors use financial analysis to make informed decisions about buying or selling shares. And here it is some of the financial statements. Uh, in the financial statement they are like we are very familiar about the in the companies like balance sheet, which is a combination of the balance assets and liabilities. In one sheet there is a long term assets and short term assets, and the long term liabilities and short term liabilities. Through this the calculation, we get to know the net worth of the some of the net worth of the company. Then by this the shareholders can invest their some of the amount in the company. Joint stock companies are required to prepare financial statements, including the income sheet statement and balance sheet and cash flow statement. These are the popular statements which are very familiar in the financial statements or also in the investing strategies. This statement provides a snapshot of the company's financial health and performance. Yes, and investors analyze use financial statements to assess the company profitability and financial stability. Through these financial statements, we can understand the trends of the companies, which is going to the like they're going to the big profit, they're going to some of the quarters they're going to profit, some of they're going to losses. To overcome these losses, we have to take this type of decisions. So we have to take the uh, liabilities and assets on a proper way of manner to utilize it. So these are the some of the questions and answers will be raised in the analyst mind to analyze and understand the trends of the future of the company. And there are some ratio analysis types. In the ratio analysis types, first let's understand the ratio analysis involves it involves calculating and interpreting financial ratios to assess a company performance. In the ratio analysis types, there are five types of analysis types. There are liquidity ratio and profitability ratio, solvency ratio, turnover ratio, and earning ratio. Liquidity ratio is are two type are one type is a current ratio. In that current ratio, there are quick ratio. In the profitability ratio, there are the gross profit ratio, operating profit ratio, and net profit ratio, return on capital employed. And in the solvency ratio, there is a debt equality and interest coverage ratio and turnover ratio. We have fixed asset turnover ratio and have inventory turnover ratio and receivable turnover ratio. And last is type is a earning ratio. This is about a profit earning ratio and earning per share. But in this all these the common ratios include the debt to equity ratio and return on equity and earning per share. Ratio analysis helps investors compare companies within the same industry, make investment decisions. So by this ratio analysis, they can compare the different type of companies who are working on the same goal or working on the same industry. By this, they can make some decision, and through this, they can invest some amount of money in their company, in that company. And there are some of the stock valuation. Stock valuation is the process of determining the intrinsic of a company shares. Methods of stock valuation include discounted cash flow analysis or price earning ratios and dividend discount model. Stock valuation helps investors assess whether a company shares are undervalued or overvalued. Investment strategies. Investors can adapt various strategies when investing in joint stock companies, such as a value investing, growth investing. Diversification is key to managing risk and maximizing returns in a stock portfolio. Long-term investors may focus on a fundamental analysis and the company's growth prospects. Let's go on to some case study of that to understand a joint stock company. We are very familiar and which most branded company in the electronic devices like mobiles or laptops, some of these. We Apple is a well-known joint stock company in the technology industry. The company stock has delivered strong returns to shareholders over the years, and Apple's financial performance, product innovation have contributed to its success and the market. Uh, we get into the another famous company, that is Tesla, which is owned by the which is run by the Elon Musk. Tesla is also a joint stock company known for its electric vehicles and renewable energy products. The company stock has experienced significant volatility due to market expectations and production challenges. Tesla growth strategies and CEO Elon Musk leadership style have influenced investor sentiment. And there are some mapping Tesla strategies. They have to set a vision what you want, and invest resource in a strategic program, and focus on an identified opportunity, and then analyzing the performance result that pays back. That sorry the Then we are go to leverage breakthrough market impact, then we go to the performance result that pays back. By all understanding these mapping Tesla strategies, let's go on to the conclusion about this. uh, we know that giants are companies like Tesla or Apple. Through these branded companies, the investors are analyze the different financial statements like income statement, balance statements, cash flow statements. Through these, they can take some of the investment decisions to invest their money and earn the stock profits, and they have to load their financial risk, personal financial risk in when the company is in loss. So this is one of the best strategy they are used by the shareholders to invest in a company. Uh, on conclusion, joint stock companies plays a vital role on the global economy by facilitating capital information and investment. Financial analysis is essential for evaluating the performance and value of giant stock company. Investors should conduct thorough research and analysis before making investment decisions in the stock market. And this is about the joint stock company. Thank you for attention and interest in this concept of giant companies. If you have any questions, I would like to learn more about this topic, and feel free to reach out. Stay informed and make informed decisions in your investment journey. Thank you for your attention. Thank you all.